So here we go. Does size matter? Well, I guess that depends on who you ask. Debatable indeed. Before you click away, don't worry, yes, you are in the right place. This is a Forex education site. So let's keep on track here. Those that know me often hear me talk about the 3 pillars that make up a successful trader. And I'm sure in the past you've seen that analogy of the 3-legged stool, where you need each leg to be working in conjunction with the others in order for it to be stable. And that is very, very true when it comes to trading. Of course, you've got the first leg. That's the strategy. I've got lots of videos out there on strategy. This must be one of the easiest legs to actually master. You can check out my videos on that at a later stage. Then you've got the trader mindset. Trader mindset is probably the most difficult of the 3 legs, the 3 pillars to indeed master. Again, we've got lots of videos out there on that, but it is an ongoing learning process, that. And then you've got the risk management, which is what I want to talk about today. And I'm going to show you why size does matter. Okay, so before we get into it, let me remind you to subscribe to the channel if you don't already do so. And as all the YouTubers say these days, don't forget to hit that bell notification. That way you'll be notified the moment my next video has been released. Getting a bit boring that, but make sure you click it anyway. Don't forget to follow us on Instagram and Twitter. If you follow us on Facebook, you can tune in live every Monday afternoon, 2 p.m. London time, where we discuss trading opportunities for the week ahead. Now, if you sign up on the YouTube channel, you can also watch me live every Monday afternoon, 3 p.m. London time. I come on discussing trading opportunities, looking for setups, trading live, also giving a bit of education in there as well, a chance for you to interact with me on a 1-to-1 basis. So I look forward to seeing you there on Monday. Einstein once said, "Eighth wonder of the world is compound interest. Those that understand it earn it, and those that don't, they pay it." I don't know if Einstein said that. Einstein spent a lot of time saying things, didn't he? Anyway, he's quoted as saying it, so let's go with that quote. Now, I'm pretty sure if you've got a credit card and you don't pay your balance back every month, I'm pretty sure you understand exactly what compound interest is, as the balance that you owe will increase each and every month. And that's basically what compound interest is. But we can use that to our advantage in Forex. So what exactly is compound interest, I hear you cry? Well, what I've done here, I put this little table together to show you the 2 different outcomes by using the 2 different approaches that you could use when trading the Forex market, or indeed any market. First of all, we've got the fixed lot approach and then the compound interest approach, and I'll show you the difference. Let's assume now we're starting with a $5,000 trading account and we're looking to make 2% on each trade. Pretty rich, 2% on each trade, pretty big target there. More about that another time. Let's assume we're hitting 2% on our first trade. On the fixed lot approach, we have $5,100, made $100. Let's assume we want to make another $100 on the next trade and another $100. So we're basically targeting $100 per trade. At the end of 10 trades, 10 profitable trades on the bounce, that's pretty good as well. You got $6,000. Now, if you use the compound interest approach, you can see here on the table very quickly that the actual increase that you see on the account is bigger because you're risking more in terms of dollars as the account grows. Now, of course, as the account grows into drawdown, you'll be risking less in dollars. Believe me, we all have drawdown periods and indeed winning periods. You want to capitalize on those winning periods and you want to protect the account in the drawdown periods. Here you'll see the numbers. First trade is the same, of course, 2% of $5,000 is $5,100, and then it goes up to $202 profit. You can see just by comparing that the increase in the account size is bigger, of course, by using the compound interest approach. At the end there, on the 10th trade, you're up $6,094, basically $94 more than using the fixed lot approach. But the big point is, of course, is that you are going to be protecting the account in drawdown, but obviously taking advantage of those winning streaks as well. Using compound interest is, in my opinion, the only way to achieve consistent gains in the Forex market. Small but consistent gains, and build that account up over time. Now, there are some doubters out there watching me now, I'm sure, saying I made 50% last month. What are you talking about? I turned $1,000 into a multi-million-dollar business. That's not me saying that, some of you doubters out there. I saw a video last week on YouTube, some young dude drinking champagne in his penthouse, got wads of $100 bills there on his kitchen top, driving a limo. If you're in that camp, I suggest you go and follow him. For me, the only way to success is by being realistic, taking regular small gains and building the account over time. So how do we achieve this in the Forex market? Well, clearly, you need to have a back-tested strategy that has an edge. Now, I've given a few examples of back-tested strategies on my channel here, so go and check them out in your own time. Today, I'm going to be focusing just on the risk. So how do you ensure that you're controlling risk on each and every trade in the Forex market? Simply, you have to use the right position size. Here's what I mean. Let's assume here that I've got a buy trade here, the trending market is up, and I want to take a buy trade. Now, with any trade you do in the Forex market, I always suggest you have a stop associated with your open position. That ensures the maximum loss that you're prepared to accept on that trade. So when you take your buy trade, you assume a certain percentage risk on the account, 0.5%, 1%, 2%, whatever that is. So you put in your stop loss, and you have a maximum risk. Here in this example, we've got a 1% risk. Now that 1% risk will always stay the same no matter where you put your stop. You can have your stop down here. You can have a stop even further away, but you're still only risking 1% of the account. The dollar loss you're going to make on that particular trade won't change. It's still going to be the 1%. So it doesn't matter basically where you place your stop because you're maximizing the risk at a predetermined amount. So how do you work that out? First up, let's look at the size of a currency transaction, basically the pip value. Now the pip value is always quoted in the terms of the quote currency. Remember the Forex price quote, there's two quotes going on. You've got the base currency and the quote currency. And the pip value is quoted in the quote currency, the second currency in the quote. So in this example, the pound against the US dollar, the pip value is going to be quoted in terms of the US dollar. Park that thought for a moment. Okay, so let's look at the size of one pip using one standard contract. You know, in Forex, one standard contract represents 100,000 units of the base currency, the first currency. So if you multiply 100,000 times the quote, you get the notional value. So here you've got the bid and the ask, one spot 2850 against one spot 2851. If you multiply them out, 100,000 times 1.2851, you get 128,510. The bid price, which will obviously be lower than the asking price, 100,000 times one spot 2850 would give you 128,500. So you see the difference between the buying price and the selling price is 1 pip. The difference in the notional value is basically $10. So the value of 1 pip in the pound against the US dollar is basically $10. Another simple way of working it out simply is 100,000 divided by 0.0001 of a lot. Okay, so now let's assume you understand that. You understand that a pip is basically 1 unit of the second currency, the quote currency. So for example, if you have the dollar against the CAD here, one standard contract, the pip value would be 10 Canadian dollars. If you're trading the euro against the Swiss, one standard contract, the pip value would be 10 Swiss francs. And euro pound, same thing, 10 British pounds. Now, of course, you don't need to trade one standard lot. You can trade fractions of one standard lot. I'm sure most of you are trading fractions of one standard lot. Certainly when you're starting off, I would encourage that. So if you're trading a mini lot, remember a mini lot is 10 times smaller than the size of a standard lot. And in the example of the dollar against the CAD, the mini lot would represent 1 CAD per pip. And Euro Swiss, 1 Swiss per pip. Now clearly, if you're trading an account in US dollars, then of course you need to convert that back into US dollars. And this is where the position sizing comes into play. Now, of course, you can actually go down lower as well, down to the micro lots where it trades for 10 cents a pip or 10 centimes a pip or 10 pence in the UK per pip as well. Now, many years ago, when I started trading the Forex market, I wrote this very, very simple spreadsheet for myself, basically to work out the pip value and how much I would need to invest when I'm trading with different stop sizes. Now this is a screenshot. I'll pull up the actual document, the actual spreadsheet now, and you can see it work. Right, here you go. Now clearly this is very old-fashioned. In the day I had to do everything manually. It's all automated now, and more about that in a moment. But in those days I used to have to put in the dollar exchange rate against all these different quote currencies. You remember, a pip value is basically 10 units of the quote currency, but I needed to get it back into the US dollars because I had a US dollar denominated account. Now clearly, because the quote currency here is the same as my account currency, the $10 would equate to $10, but because it's basically £10 a pip, I've got to get that back into dollars, and I use these exchange rates to get back. So basically anything against the British pound would be $12.85 as of today of recording, Canadian dollar $7.48, Australian dollar. So these are basically the pip values for one standard contract. So I used to update this every day because obviously these are changing every day as the US dollar fluctuates against the quote currencies. But what I do here is basically work out the lot size I need to know order to establish a percentage risk that I have allocated to my trading plan. So let's assume I've got an account size here of $10,000 and I'm using a risk per capital in there, hope you can see it, 0.5%. 0.5% of $10,000 clearly is $50. I'm only risking $50 per trade. But I might want different size stops. So for example, if I want to trade here say the top one here with a $10 per pip, I want to risk $50, but I want a 30 pip stop, I would have to trade 0.17 of a lot. So basically I'd have to trade 0.17, that's basically a mini lot. Now look what happens here if I move my stop to say 60 pips. Moving that to 60, what's going to happen to the 17? Clearly that's going to pretty much halve because now I need a bigger stop. I need a bigger stop, so I need to reduce the lot size. Let's have a look here. Whatever it is against the Swiss franc, at the moment it's $10.86 per pip. At the moment I have got the same amount of dollar risk, $50. That's 0.5% of the account. And let's assume now that I want just a 25 pip stop. Okay, look what's going to happen to the lot size there, moving from 0.09 up to 0.18. So now I can have a smaller stop, but basically means the position size I'm taking is going to be bigger. So I'm adjusting the size of my trade. It's doing it automatically here, establishing just the 0.5% risk. If I'm wrong, doesn't matter the size of the stop, I'm still only risking $50. Very, very useful way, and I used to rely on this all the time as well. And of course, if I want to change this to say 1% risk, then obviously all those numbers would change as well. I'm now risking $100, and the pips lot sizes would change as well. So this is what I used to do in the day. You don't have to do that now. We've got it all sorted out for you. And if I can just pull up this page here. So there you go. This is our lot size calculator. Now a lot of the brokers offer this type of tool as well. Do go and check them out, or you can use ours. It's absolutely free. You don't even need to register. Just go to ForexSignals.com/lot-size-calculator. I'll leave a link in the description tab as well to say it's absolutely free. Don't need to register. Bookmark it, save it, and share it with your friends if you wish as well. So you go to calculator, and everything there is self-explanatory. You just have to fill in the details. If you are in doubt, then some of the instructions there for you to follow. I'll tell you what I'm going to do. I'll just jump onto the screens now and show you in close-up, so you're not going to strain your eyes watching this work. Okay, so this is slightly clearer for you. There are some instructions there if you need to have some more guidance, but basically you need to select your instrument. I could say select the euro against the Oz, for example. My deposit currency, I use a US dollar account. I need to pick my entry level. Time of recording, the euro against the Oz is trading around 1.6400. Let's have a stop at 1.6350, so that's about a 50 pip stop. Here I can select to have percentage of risk or fixed amount. We're talking about risk percentage, so I'll leave it there. So I'm going to risk 1% of the $5,000 account, and I hit calculate, and it basically does all the calculations for me. So my risk amount, $49, that's 1%. Of course, you've got the spread in there as well. It tells you my entry price, my stop level, and it works out the position size for me, 0.14 of a lot, pretty much like I showed you on my really old-fashioned Excel spreadsheet. Do another quick one. So we might want to select, say, the pound against the dollar, same US dollar account, trading price at the moment. What is it? 1.2850. Might have my stop in there at 1.28, say 25. $5,000 account still. Percentage risk, 1%. Calculate. Again, risking just $50. Position size on this trade will be 0.20 of a lot. And those are my levels, confirming the percentage risk. That basically is how it works. Now, if you scroll down here, you'll also see instructions on how position size works. And there you go. You can click on that little question mark there, and it gives you a brief description. We also actually have an expert advisor, an EA, which you can use as well. You can plug that onto an MT4 chart. I'll just quickly show you that now before we end up, so you can see exactly what that looks like. Here we go. Okay, so here is the expert advisor, which I've installed onto the MT4 platform. Okay, what I've done here, I've set my percentage risk on this to 1%. I can change that, of course. Turning on the risk manager now, and you'll see 3 lines. You've got a green line, which is my take profit target. You've got the yellow line, which is my entry line, and you've got the stop loss level, which is below the entry line. So on this order, I'll be a pending buy limit order, waiting for the market to come back down. Okay, I've got my stop in place, and as I move my stop, look how the lot size on the panel there changes. Okay, it's 20, 21, 22. So as I move my stop closer in, pretty much like I showed you on the Excel spreadsheet there, the lot size increases as my stop distance decreases. If I need a really wide stop, I've got to trade a lot less lot size. Okay, this does all those calculations for you as well. This does a little bit more as well, actually. Works out the risk to reward ratio, tells you the dollar amount. There's a percentage risk. I can also trade with this as well, so I can literally just place the pending order. This is a live account, so I'll just place it below. So there, that order has been sent to the market. It's a pending buy limit order. I need to delete that. As I say, this is a real account. I can also select on this expert advisor to have 2 profit targets. So I can turn on the risk manager again, have a pending order below, and I can have multiple profit targets as well. So if I want to exit in 2 parts, it basically sends the order to the exchange or to the market in 2 tranches. Really cool piece of kit. And on this tool, I can also use buy stop orders and sell stop orders. So now, for example, if I was to place my entry line above where the current price is, stops in there, profit targets up there, it would convert to a buy stop order. So there we go, pending buy stop order, and that now is in the market. Again, I'll pull that. So there you go, there's an expert advisor, should you wish to explore with that. But the lot size calculator, it's absolutely free, so do go and try it out. Hopefully you'll see an improvement in your trading. Okay, so there you go. Hopefully you enjoyed that. Hopefully you learned something. Hopefully now you can see the power of position sizing, why it is so crucial, why it protects your account in terms of drawdown, and also accelerates your account in terms of profitable periods as well. It's so crucial if you want to grow a Forex account. Now, if you like my video, give me a thumbs up. If you didn't, give me a thumbs down. Don't forget to leave a comment. I get back to all of them as well. Don't forget to follow us on Instagram, Twitter, and Telegram. Don't forget to follow us on Facebook. There you can tune in live every 2 p.m. London time for a live event. And you also follow me as well, 3 p.m. London time. I stream live as well to the YouTube followers, looking at trading opportunities, discussing some education points as well. Your chance to engage with me live as well. So hopefully we've answered that question there. Does size matter? You bet it does. Just don't tell the wife.